Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, hey, I'm just trying to make a little bit of money here. My job is not just to entertain, but to educate, to teach you. Call me, 1-800-743-CNBC. Tweet me, Jim Cramer. Okay, we keep hearing about the overstretched consumer and the chilly job market. Now, based on this endless drumbeat of negative news, shouldn't the stock market, by all measures and means, be way down? Just today, we got some ugly data points. The ADP National Employment Report was downright hideous, showing private employers shed 32,000 jobs in November. Obviously disappointing. Wall Street was looking for 40,000 new jobs. Initially, it pummeled the averages before a late morning rebound that transformed into an out-and-out rally. Dow finishing up 408 points, S&P gaining 0.30%, NASDAQ advancing 0.17%. Odd, right? How could that happen? And when you check under the hood of this ADP data, it's even worse. ADP's chief economist, Nella Richardson, stuck a dagger into the growth economy narrative with her commentary. Listen to this. Quote, hiring has been choppy of late as employers weather cautious consumers and an uncertain macroeconomic environment. And while November's slowdown was broad-based, it was led by a pullback among small businesses. Okay, I ain't no economist, but I know the job market. Small businesses, not large businesses, are the backbone of the American economy. Large businesses lay off people to increase profits. Small businesses hire so they can expand. See, the ADP numbers are a sign of real economic weakness. You'd think that's a bad thing for the stock market, right? Wrong. Let me show you why numbers like the ADP SAD-SAC tally actually paved the way for what could be a terrific rally, maybe through the end of the year. First, for months, this market's going higher in anticipation of rate cuts from the Federal Reserve. But the Fed can't cut rates if the economy's too strong, and that goes double for the job market. These ADP numbers are exactly what the bulls needed. They make it so much easier for the Fed to cut. And maybe cut, and maybe cut. Hey, keep in mind this morning we did get another report called ISM Services PMI. It's gobbledygook, authentic Wall Street gibberish for the business temperature for the month of November. And buried in it was this line with such huge implications that it should have been the lead of any top-down discussion. It's fair. Let me quote. The prices index registered 65.4% in November, its lowest reading since hitting 65.1%. In April 2025. The November figure was a 4.6% drop from October's reading of 70%. We got weakness in hiring, okay, especially where it hurts small business, and we got lower inflation. You know what that is? How about nirvana? How about Goldilocks? How about actual ecstasy? Because not only will it allow Jay Powell to cut interest rates at the next Fed meeting, also in subsequent meetings. Because slower growth with lower inflation gives you the possibility of multiple rate cuts that can breathe new life in the economy. Oh, and by the way, whatever might be left of the rate when Jay's done will get hacked some more by the new guy. Now, that's how you get what I call blow-off top. That would be the least expected of all results that I hear about between now and year-end. There's only one problem. This potential monster rally is hidden in plain sight. See, we're spending so much time on tech, the data center, the power needed for the data center, the cost of the data center, the expense of the semiconductors, the possible cracks in the AI thesis, the jobs to be taken away by AI, the earnings of the hyperscalers, the potential slowdown in Microsoft, the number of iPhones really sold, the foibles of OpenAI, and the endless attacks on NVIDIA, that many people might actually miss this entire move. See, right now it's very easy to be blinded by the brutal trench warfare in tech. So let me help you remove your tech blinders so you can stop worrying about the next hit job article that assassinates Adobe or ServiceNow, or the one that assassinated Salesforce. It's not looking so smart right now. I'm going to start with the most important element of this rally. It's built on the backs of the most important group in the entire market, which are the banks. They're the real measure of the economy's health. After consolidating post-earnings, the group is roaring, led by Wells Fargo and Citi, Bank of America, JP Morgan, right there with them. Picture perfect. Even better, Capital One, COF, and American Express. The lower and higher-end credit card companies are challenging their old highs. I think they take them out. Second, there's retail. In all my 40 years of following retail, I can't recall a time when so many chains were doing so well that there is this much full-price merchandise for the holidays. Things just aren't on sale. There's no promotion. Every day we get a new set of retailers doing amazingly well. Just today, Dollar Tree reported a really terrific quarter. Like Walmart starting to appeal to a higher-end demographic. Those who thought this chain would be hurt by food stamp cutbacks, they read the room totally wrong. How about Macy's? Wall Street expected a dismal report filled with talk about promotional holiday season. That's what they're used to. Not this time. We're finally starting to see the benefits of closing weak stores. By the way, 9% same-store sales increase from Bloomingdale's, and that's where the current CEO, Tony Spring, came from. Lots of people thought that the last quarter from American Eagle was aberrant. It was so great, a flash in the pan. The terrific numbers this morning put a lot of that notion. And that's not all. Consider this list of retailers that performed sharply better than expected. Tapestry, Ralph Lauren, Kohl's, TJX, Urban Outfitters, and, of course, Walmart. In fact, I can only recall Target, Burlington Stores, and Home Depot being disappointing. That's extraordinary. It should not be happening when there's a slowdown in hiring. Of the disappointers, Home Depot is the most sensitive to a decline in interest rates. The Fed's meeting is next week, so things could turn around real fast for the despot, which is higher than where it reported that bad quarter. That's why we own it for the Travel Trust. Why don't you join the club? Find out more. Next group that gets some more, the transports, which are also in breakout mode. We know that Union Pacific's doing extraordinarily well, about to merge with Norfolk Southern. Great situation. I think FedEx is a coiled spring. We've yet to hear a single disappointing e-commerce story save Target. Fantastic setup for FedEx. Also for J.B. Hunt and ArcBest. I think they'll have a good run. Then it might be come back to the drug stocks. Why? Well, remember, lots of people think the economy stalled or in a tailspin. They're wrong. But they'll want to participate. When money managers are worried about the economy, they reach for Johnson & Johnson, Merck, Eli Lilly, Vertex, Nuance, Amgen, and even lowly worm Bristol Myers, now that it's got a readout on some drug for agitated Alzheimer's patients. No, it wasn't an approval. It wasn't even a well-run trial. It's just that they didn't have to cancel it or say that it doesn't work. And on that really incredible news, the stock pulled forward at 5.6%. Unbelievable. How about Apple and those Chinese numbers? Time to defy gravity and buy Microsoft? Jensen Huang's on the Hill. Can he get NVIDIA back into China? Oh, please. I'm tired of those. Here's the bottom line. For once, we have a genuine macro rally. Let's stop obsessing on what we don't know about tech. And let's just own, not trade Apple and NVIDIA and get along the real economy stocks that could be poised for a world championship run for the roses into the end of the year, barring something crazy coming out of the White House. Yep, stop stressing about AI and go buy some banks or some retailers. And while you're at it, take a couple of transports. Let's go to Heinrich in Texas. Heinrich.
Hey, Jim, booyah.
Booyah, my friend. What's happening?
It's a pleasure talking to you. I have been watching your show for the past 10 years and investing. I am a member of your club, and also I just got the book.
Oh, my, you are cadre. You're cadre.
Yep. You've been so instrumental to my life and to the life of my 12-year-old and a 9-year-old that are watching you too. So
thank you. That's great. Investing. Good. I want them to know what to do when they get the money, all the money you've made them in stocks. Let's go to work.
All right. So, Jim, I've been holding Palantir for the past few years. And currently, Palantir is down. Yesterday it was down about 16%. Today it's down about 10%. My question here to you is, from your perspective, is this the kind of corrections that where long-term investors should buy the dip? Or does it make more sense for us to take some profit out and rotate part of that position into value stocks and maybe pharmaceuticals?
All right, now I'm sure the stock was Palantir. That's what I thought. I want to be sure. All right, I don't want you to sell Palantir. Palantir is a great high growth name, high quality name. Alex Karp is a bit of a wild man. I don't mind that. I think that they're doing incredible work. Now, I know there was an article in the Washington Post about them working with ICE. You have to keep your politics out if you want to make a lot of money. Not that I'm like crazy about what are some of the things they do and they don't. But if you're asking me whether I think the stock's going to higher, which is what I think you are, as well as those kind words, I think Palantir is going higher. Okay, we finally have a real macro rally points, not a tech rally. And I think it's time to go long in the stocks that could be poised for a championship type run into year's end. And look around. They're all around you. No more data center. CrowdStrike reported last night and beat estimates, but the stock was relatively flat in today's session. What gives here? I'm making some sense of the quarter of the CEO. And what do you do when Lowe's goes higher? Hey, I'm digging the conglomerate, not the home improvement store. Fresh off the company as addition to the new high list again. And Snowflake turned in this quarterly results after the bell, and they're confusing. I'm running through them anyway. We'll figure it out. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
sometimes the cybersecurity stocks go out of style. But as I lay out on how to make money in any market, the cybersecurity business never goes out of style. The risk of being hacked is just too high, especially now that the bad guys have access to the tools, the artificial intelligence tools. Which brings me to CrowdStrike. It's a key position in my Travel Trust, has been for years. Reported what I thought was a pretty darn good quarter last night. Company posted a nice top and bottom line beat, while their net new annual recurring revenue, the key metric, came in at $265 million. Wall Street was only looking for $239 million. Maybe all you need to know. Of course, the stock temporarily pulled back in response to the quarter, but opening down almost $20 before rebounding to finish up more than $8. And that's what almost always happens with CrowdStrike, and then the stock tends to bounce back. So let's take a close look with George Kurtz. He's the co-founder, president, and CEO of CrowdStrike. To learn more about the quarter and what comes next, Mr. Kurtz, welcome back to Mad Money.
Great to be here, Jim.
Oh, thank you, George. Now, George, I'm going to do this interview a little different. This conference call I've got, I have to do the interview different because you see the trophies behind you? This was a trophy quarter. And you, who are very matter of fact about things, actually started the call by saying CrowdStrike's fantastic Q3. You were all in. This is a different kind of quarter, isn't it?
Jim, we had a monster quarter. You know, if you look at our records, we had a record Q3 for annual recurring revenue. We had a record Q3 for free cash flow, almost $300 million. We had a record operating income. So when you look across the board, it was a monster quarter. We delivered broad-based success across all geographies, all platform modules. And I think it shows that CrowdStrike is the platform of choice in cybersecurity.
Now, you did something in the narrative that I thought was also very interesting. It was like you left crumbs. It was like Hansel and Gretel. Accenture, okay, F5, EY. These are all the appliance company, F5, but these are all thought leaders, as if we were in medicine. And you want these thought leaders because they are not one and done. They are companies that delve out contracts in your behalf. Is that what happened? Do you have Accenture and EY just literally saying, listen, you got to go to CrowdStrike?
Well, that's it, Jim. We've invested in our partner and our channel community. And when you look at some of these global SIs, we've spent the time and effort to not only educate them, but enable them. They've got the relationships at the highest level in these enterprises. They're helping to make decisions and drive buying purchases for these large companies. So we're providing fantastic technology. They're able to wrap a lot of services around our technology. And really between us and our GSI partners and other partners, we're focused on giving customers outcomes, not just technology, but outcomes of stopping the breaches, saving money, saving time, reducing cost and complexity. And that's why all of these big partners are embracing CrowdStrike.
Is that also why Jensen Huang endorsed you as being the best?
Well, look, we've got a fantastic relationship, and you can't say AI without Jensen Huang and NVIDIA. And to be featured at his conference in Washington, D.C., I was there. We're the only security company that had its own slide and was called out by Jensen. Again, we've got the right technology. Not only that, we've got the right people behind it, and we have like minds. We're focused on solving customer problems and using AI in ways that haven't been contemplated before.
And is that why AWS said you're the best?
Well, AWS, longtime partner. We've talked about AWS for many, many years. I saw you had Matt Garman on last night. We're part of reInvent. And what did we do there? This is actually, I think, a game changer. We are now integrated within AWS natively, where customers of AWS can use Next-Gen SIEM. They can pull it up in their console. The billing will happen automatically through AWS. And really, we're going to drive a lot of momentum and new customer adoption because we're now part of the ecosystem there. And I think we give them a great competitive technology against some of the other hyperscalers that are out there. And look, they have their choice to pick whatever technology they want. They picked CrowdStrike.
Are these Kurtz to Matt, or is it Kurtz to Julie? I mean, in other words, are you sitting down with the tops of these companies and saying, listen, we have what you want? Because I know you as a guy who says, I'm going to make this contact. I'm going to get this done.
Well, it's absolutely true. I had dinner with Matt a few months ago. We talked about this. We talked about a lot of other things, our partnerships, how we can do more together, what's happening in the industry. When you see all the changes, you see how fast things are moving. And, it starts at the top. But it's all about people and relationships and doing what you say you're going to do and delivering the best value for customers. That's what Amazon and AWS is all about, and so that's what CrowdStrike is about as well.
You left another clue. You talked about a Fortune 500 consumer packaged goods company that was, well, that happens to be involved with the displacement. Wiz being bought by Google. That deal is not closed. But when you've taught me that when you have this kind of company being bought by another company, that's your chance. Almost every consumer packaged goods company that I looked into during the Clorox terrible hack didn't seem to know what to do until you called them, even though they weren't your client. Is it this kind of thing where now Wiz is a place to be able to, and it could be even an annuity stream for you?
Well, whenever there's disruption in the market, whether it's in cloud security, whether it's in the SIM market, you name it, it's an opportunity for us because customers are looking for the best outcome. They're looking to consolidate. And if they have to make a choice or change vendors or, have to make contract decisions, it's a natural point for them to open it up to the market and say, what else is out there? And with our Flex contracts, we have many, many customers saying, we want CrowdStrike, we have Flex. We want to put it under a Flex contract, and we want to be able to use it and double down on CrowdStrike. And that's what we're seeing across the board, not only in cloud security, but certainly in next-gen SIM and in identity as well.
Okay, so how could there be a government contract with 75,000 endpoints of legacy coverage that goes to you? And just, what, did they just realize, wait a second, ours isn't up to date and we're concerned?
Well, Jim, if you look at the current administration, it's exciting because it's really for the first time that they're operating like a business. They want to consolidate. They want to save costs. They want to procure at the macro level, not just piece parts. They have less people today than they had in the past. So they're going to need better outcomes. They're going to need better security. They want to save money for the American taxpayer. And CrowdStrike is a fantastic solution given the current threat environment. And we've seen how prolific the nation state actors are. And we're going to be there to help secure our national interests. Okay.
Now, the last thing I want to ask about is that people need to know, and it was questioned on the call. There was a good question, can't be dismissed. Why are we focused on ARR growth and not other things? Why is ARR growth accelerating to 73%, the metric, and not what you're doing in small, medium-sized business? Can you help our viewers understand, unlike the analyst, who's probably a nice person, that it is the right metric?
Well, it is the right metric, Jim. And, when we became public in 2019, we were literally one of the first companies to really disclose ARR. And we didn't focus on billings, which is kind of a noisy metric. Mm-hmm. And you see others trying to follow suit in annual recurring revenue. But basically, that is the health of the business. What is your annual recurring revenue, right? And the beauty of our model and the SaaS model is you keep layering new revenue on top of new revenue until you get to near 5 billion annual recurring revenue. So in the quarter, what we called out was 265 million of net new ARR, and that just keeps adding to our total. And again, the more you grow it, the bigger it gets, the stickier it gets, and you see the success in the numbers that we put up.
Well, this was the culmination of a lot. We didn't have to talk about any sort of thing that happened. I know something happened a year ago. I don't remember. It was like a shutdown of some things, and you were involved. That's how I feel about what's happened here. That was past. Not even worth talking about.
Rear view mirror, Jim. What we're focused on is customers, new customer acquisition. We did some great acquisitions. Which were de minimis in the quarter in terms of their revenue contribution, but the technology is fantastic. And again, we've got the right platform at the right time with the right momentum.
Well, congratulations, George Kurtz, co-founder, president, and CEO of CrowdStrike, who actually, quite candidly, predicted every bit of this was going to happen. Thank you, George.
Thank you, Jim.
Mad Money's back after the break.
Coming up, a sleeper stock is waking up. With Lowe's Corporation rallying, Cramer's explaining what's behind the run and whether the move can continue. Next.
Not all bull markets are noisy, like the high-profile moves in the AI data center stocks this year, or the super speculative plays that were working very well until a few weeks ago when the year of magical investing ended. Some bull markets are quiet, sottovoce, like the almost silent move in Lowe's Corporation. That's L-O-E-W-S, or letter L for you home gamers. A conglomerate of insurance, hospitality, energy infrastructure, and packaging businesses. Lately, Lowe's feels like it's achieved almost permanent resident status on the new high list, at least until the stock pulled back over the past few days. Good opportunity here. Now, there's one, this is an enigma. It's the only company in the S&P 500 that has zero analyst coverage. Pretty crazy considering it's got a market capitalization of really $22 billion. Maybe that's why so few seem to have noticed that Lowe's keeps marching higher, up almost 25% year to date. Reminds me of Seaboard, another conglomerate with no analyst coverage and a stock that just won't quit. I only found out about them last week because they have their own Butterball turkey brands among many others. Now, the last time I recommended Lowe's was way back in April 2022 when the stock was trading at around 63. It's now at 105 and change, up 67%. That's versus 53% for the S&P 500. Nice win. But in the 5 months after that segment, Lowe's pulled back to 49. So you had to take a leap of faith on this one. Since then, though, the stock's more than doubled in little more than 3 years. Especially in recent months, this one's caught fire. So what's driving the move? Okay, first let me give you some background. Lowe's is what we call a holding company, consisting of 4 businesses in 4 distinct industries. The company gets more than 80% of its revenue and about 62% of its profits from its 92% ownership stake in CNA Financial. That's a gigantic property and casualty insurance company. Lowe's also owns a company called Boardwalk Pipelines. That's a natural gas and nat gas liquids pipeline and storage play. And that made up about 12% of their sales last year and 29% of their profits. They've got Lowe's Hotels, which is only 5% of the business, but it's probably the one you're most familiar with. Finally, they've got a 53% stake in a smaller rigid plastic packaging company. That's called Altium Packaging. It made up 4% of their earnings last year. Beyond that, it's important to remember that Lowe's is a family business, a great family, and a great business. At the beginning of the year, former CEO James Tisch, the second generation, passed the role to his son, Ben Tisch, whose older sister happens to be the New York City's police commissioner. She's staying on, by the way, under the new mayor to the collective relief of everyone who was worried about public safety. Now, you never know with these family business situations, but in the first letter to shareholders earlier this year, Ben Tisch explained, quote, like my father and his father before him, I believe that the CEO of Lowe's Corporation has one job, and one job only, to grow intrinsic value per share, end quote. Sounds good to me and has the added advantage of being true, as I know his father and I knew his father before him. The best we have in business in this country, honorable is the word that comes to mind, first and always. Lately, the company's been doing a great job of growing intrinsic value because its 2 largest businesses, CNA Financial and Boardwalk Pipelines, they've basically been printing money. Through the first 9 months of the year, Lowe's net income from CNA was up a solid 4.3%, including a much more impressive 43% jump in the most recent quarter. As for Boardwalk Pipelines, its earnings grew by nearly 25% through the first 3 quarters of the year. The smaller businesses are both down this year, but they're simply not large enough to pull anything down. They don't move the needle. Remember, CNA and Boardwalk collectively account for more than 90% of the sales and earnings at Lowe's. So why don't we start with CNA? The past few years have been a very good time for the property and casualty insurance space, with insurance premiums rapidly on the rise. At the same time, we've had relatively high interest rates since 2022, which is terrific for this industry because insurance companies like to take your premiums and invest them in the bond market. There's a reason the other majors like Progressive, Allstate, Chubb have been such terrific outperformers for the past 5 years or so. The most recent quarter was especially strong for CNA, with its profits up 43% year over year, thanks to better underwriting results and higher net investment income. Now, some of that's, frankly, because we had a milder hurricane season, though it's not necessarily something we can repeat. As for Boardwalk Pipelines, regular viewers know that I'm a big fan of these energy toll roads with little exposure to the actual prices of the underlying commodities. We've got a ton of liquefied natural gas export terminals being built, which is great for Boardwalk because it means more volume going through their pipes. Plus, all these new data centers are desperate for electricity, which translates to more demand for natural gas that goes through pipes. Boardwalk saw its net income grow 22% year over year in the most recent quarter, and they've got 8 major projects. These are all growth projects still in the works, including several in the Gulf Coast region that will keep that growth rate growing. That's very good news for Lowe's, the parent company. Geez, I remember when this pipeline seemed to go nowhere, and I thought it might be a bad acquisition, but Lowe's, it took a longer-term view than I had, and it's really paying off. Now, there's one more reason why this stock's become a quiet juggernaut, and this may be the trick. The reason why it just won't stop. See, Lowe's is a steady repurchaser of its own shares. From the end of 2014 until the most recent count at the end of September, Lowe's retired an astounding 45% of its common shares outstanding, reducing its overall share count from 373 million to 207 million. They can afford to do this because the CNA financial business throws off a ton of cash and distributes much of that cash via dividends. CNA trades independently where it has a very attractive 4% yield. In reality, the payout's even better because every year since 2014, CNA has also paid you a special dividend. This year it was $2 per share, which means the actual dividend yield for 2025 is north of 8% when you include that. Here's some quick math. Lowe's owns roughly 248 million shares of CNA Financial, so they got around 954 million in dividends from the subsidiary in 2025, and that's enough to cover the cost of all their share buybacks in each of the past 4 years. Talk about a great business model. Even with flat profits, those buybacks still translate into some terrific earnings per share growth. How about the valuation? All right, Lowe's trades at roughly 16.5 times last year's earnings. That's pretty reasonable, especially compared to the S&P 500, where some people think it's trading at 28 times last year's earnings. I prefer to use a forward valuation based on future earnings estimates, but there's no analyst coverage here. Still, though, through the first 9 months of 2025, Lowe's put up 8.8% earnings growth. If they can keep that up in the fourth quarter, they'll make just under $7. $7 per share. That means the stock's trading at just roughly 15 times my back-of-the-envelope earnings estimate, and that is really cheap, especially given the high-quality management here. So here's the bottom line in this story that is not exciting, and I don't care. It's easy to see why Lowe's keeps making the new high list. That I like and is exciting, and I do care, even though it doesn't get as much attention. The core insurance business is doing great. The second most important business, Boardwalk Pipeline, is really coming on its own. Meanwhile, the secret sauce here is the company steadily buys back shares. One reason the stock's still so darn cheap, even after a big run. And that's why I still very much like Lowe's, letter L, here. And if you come back next year at this time, I'll probably like it even more. Let's go to Dustin in Oklahoma. Dustin.
Good evening, Mr. Chill. It's good to talk to you again.
I'm chilling.
To get to talk to you this week. Hey, you're chilling. I love it. Hey, it's fitting to get to talk to you again this week. Our two teams are meeting up on Monday night. I rarely get to play the Birds, but my lifelong Chargers are going to see what we can get from you this week.
It's going to be a huge game. It's going to be. Look, I want to win fair and square. I hope your guys left-hand heels, non-throwing hand.
I hope Herbert can play as well. We're looking forward to it. I'm rooting for a good one. Well, hey, I'm calling you tonight about one of my newest AI plays that I absolutely love. It is about a multiple of 96, and you know, the fundamentals sound really good to me since their newest acquisitions of any business right now is going into 2029 already, and it is my newest favorite stock. So I'm going to ask you again what you think for the long term of GE Vernova and what you're looking at.
GE Vernova, my Chapter thank you for the kind comments. Let me make this really straight. This whole uranium thing, the whole nuke thing, if it happens, it's going to be GE Vernova. More importantly, if it's nat gas, it's GE Vernova, which means it is the only real company in that whole power segment that everyone's so crazy about to speculate on. Don't speculate. Invest. GE Vernova. Even though it doesn't get a lot of analyst coverage, it's easy to see why Lowe's keeps making new highs, and I still like it here even at these levels. Bunch more money ahead, including my post-earnings exclusive with Snowflake. I'm breaking down all the important headlines out of the cloud company with the CEO. And we've had them before. The stock's up big over the course of the last year. Then if you must trade zero-day options, 2 times levered ETFs, or any uranium data center quantum play out there, then I got a message for you, partner. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What the heck just happened to the stock of Snowflake? The company reported a seemingly robust quarter after the close, and stock's breaking down after hours trading. That makes sense? I don't know. Some of that's because Snowflake was up more than 70% for the year going into today's close. This is one of the rare software companies that's convinced Wall Street it can make a killing from AI rather than just be killed by AI, and the numbers have mostly backed them up. Today, there was a fly in the ointment. Snowflake's operating margin guidance for the current quarter came in about 7%. Analysts were only looking for 8.5%. But in other words, it was lower than people expected, but enough to torpedo the stock? Does it deserve to sell off? Let's check in with Sridhar Ramaswamy. He's the CEO of Snowflake. Get a better in the quarter and what comes next. Mr. Ramaswamy, welcome back to Mad Money.
Hi, Jim. Good to see you.
Okay, so Sridhar, we got to deal with this niggling thing that I think is just going to be forgotten about by 10:30 tomorrow. But there's some people, some press headlines that say, wait a second, there's a weak profit margin. It must mean that they're not making as much money as people think in AI. A complete fiction, but I'll let you knock it down rather than me.
Well, first of all, Jim, we had an incredibly strong quarter when it comes to revenue. $1.16 billion, growing 29% year on year. Great product momentum. It's all about creating amazing products. We are very proud of bringing Snowflake Intelligence to GA, adopted by 1,200 plus customers right out of the gate. Amazing names like the USA Bobsled Team and Fanatics and so many more. The thing that I'll tell you, though, we are doing this with focus, speed, and also operational rigor. There is a lot of attention being paid to how do we do our jobs more efficiently? How do we practice what we preach when it comes to AI? And the gains that we're seeing internally in terms of how we operate are going to be very efficient. That's the magic of Snowflake, which is we will continue to grow at these impressive rates. That's why we raised for the whole year by a pretty big $51 million while being responsible and running the business extremely efficiently.
Well, that makes a lot more sense to me, and I think that people will look at something like the AI revenue, $100 million run rate already. Can you tell people first how you can isolate AI revenue when you look at what you get, and what are people getting, what are the customers getting for what you're doing with AI?
That's right. Well, one of the things about Snowflake is that the consumption model ties us very, very closely to customer value. That and our obsession on making things simple means that experimentation with AI for our customers is dirt simple. There's no new contract. Everything comes out of the box. You can build a chatbot. You can build a data agent. We give you amazing tools so that you can do that in a matter of days or weeks, not months or years. So you can get on this nice feedback loop. The bulk of the $100 million in ARR in AI revenue comes from the Cortex family of products. Everything from being able to use AI functions when you're running SQL, to being able to talk to structured data, which is our specialty, and then the flagship product, Snowflake Intelligence, which is game-changing, Jim. If you had one, what you could do was both ask questions about, hey, how is the quarter doing, how is revenue, but also questions like, what questions did I ask Sridhar the last time he was on Mad Money? It is that instant access to data without needing analysts, without needing data scientists, without needing to wait for days or weeks. That makes Snowflake truly magical, and that's the value that we are delivering. Anytime I show this to a CEO, they go, I want that. And that drives more people to want to put more data on top of Snowflake.
I don't blame him. I think that's terrific. I like the reference, too. Now, you also made a reference that I got to follow up on because it's something I wasn't going to bring up unless you did, but the USA Bobsled Team did come to you because milliseconds matter. Tell us what they're doing with you. I think that will help a lot of people understand who don't understand what Snowflake really does.
Well, you know this. Sports is complicated. And with things like the bobsled team, a single millisecond can sometimes be the difference between a gold medal and no medal. And those folks obsessively look at every single factor that goes into how a bobsled operates, to what's the push rate, to when does somebody get into the bobsled, on and on and on. And what something like Snowflake Intelligence does for the coaches, it gives them instant access to the entirety of the data set. They can look at how do I go about optimizing, how do I gain insights on what's working, what's not working. It basically lets them iterate, run experiments on how they can get better in real time without the need for complex data science. It simplifies the hard to do, which is really our specialty. We make the hard easy for our customers to do.
Now, another outfit I know, the hard-nosed business people, I see their ads. They follow me wherever I go. I don't mind that. They're from Philadelphia. It's called Fanatics. They are a global leader in sports merchandise, for those who don't know them. They have enlisted you, and it seems like a very good partnership.
That's right. They have over 100 million customers doing everything. They have esports. They have merchandise. And they use it to analyze the behavior of these customers, put data at the hands of the people that are optimizing them. So we are a big part of them rolling out a sports advertising network. It is that ready access to data that makes this such a great partnership between them and us.
Now, one thing I need to know is that we had AWS on last night. They're terrific. You're partners with them. And they're talking about cloud migration still early. They're talking about maybe 20% has been migrated to the cloud, 80 not. Is there really that many people who are still on premises, not in the cloud?
Well, that tells you the amount of opportunity that we at Snowflake have. And here's where AI is very powerful. I told you earlier, if I show Snowflake Intelligence to a fellow CEO, the first thing that comes out of them is like, I want that. Right. How do you have information about all of your customers right on your phone? I want a similar thing. It's exerting a powerful pull. What we're also doing at Snowflake is using AI to make things like migrating data from legacy systems onto Snowflake a whole lot easier. So I call that the push-pull phenomenon of how there is more drive to do more things with Snowflake. And it's very early when it comes to cloud migrations. And AI, I think, will be a massive accelerant for us, as well as folks like AWS, one of our largest partners. We've spent $2 billion through them, through the AWS marketplace. That gives you an idea of the volume of joint work that we are driving.
And last, just shortly, this deal you announced with Anthropic, $200 million partnership, bring agentic to global enterprise. Pretty good deal. A lot of people talking about Anthropic. This one came together quickly.
It did. You know this, they are among the very best model makers in the world, beloved by developers for coding agents, for example. And what this is going to let us do is bring their flagship models to all of our customers securely within their Snowflake deployment. We are also going to be working on going to customers together, doing joint go-to-market, as it were. So it's going to be a very fruitful partnership. We work very closely with that team, and it all heralds to the tremendous potential that Snowflake has in the upcoming quarters and years.
Excellent. Well, Sridhar, look, I know this is a great quarter. There's just no flies on the wall, and I'm so glad you came on. Sridhar Ramaswamy is the CEO of Snowflake. The stock will be down, then it'll be up because it was a great quarter. Sridhar, thank you so much. Okay, don't miss out. This is your shot to join me in the Investing Club and get in on our live morning meetings at 10:20 each day. We go through the club's portfolio. Act fast, scan that QR code, go to cnbc.com/Cramer Club. I want you to be a member. This is the best time all year to join the club. And now it is time. Some of the light round questions are proper. We'll see the stock center. Bye. Social media report. Is that right? My staff person, grab somebody. You play this down. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer's round. We'll start with David in California. David.
Mr. Cramer, it's an honor to speak with you. I'm calling about a stock called Lumentum. I take it.
Lumentum, yeah. I mean, look, this is just a red-hot spec stock that actually makes money. I'm going to say it's okay as long as we recognize the spec. Let's go to Wesley in Texas. Wesley.
Yes, sir. Thanks for having me on, Jim. I'm calling about ticker symbol MSCI.
Okay, that's one of my absolute favorite stocks. It's been a complete winner. It's been a winner for ages. The reason why it's been a winner is, frankly, because Henry Fernandez runs it. I think he's great. The stock's down 9% for the year. What an opportunity. Let's go to Mark in Wisconsin. Mark.
Thank you, Dr. Cramer, for taking my call.
My pleasure.
Got a company here for you that I own. Buy, sell, or hold. Digital Bridge Group.
All right, that's data centers and it's cell towers. It's all the stuff that I'm saying right now. I'm going to say no. I'm going to say pass. Let's just take a pass right now. It's not the right stock for this moment. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
I've said it before, I'm going to say it again. The year of magical investing, it's over. It ended in November. Whether we're talking 0 days to expiration options or double leverage ETFs or the high-risk speculative stocks, uranium, quantum, flying cars, crypto miners turned AI data centers, these things will not regain their ill-fated heights, even if we have a monster rally like I predicted at the top of the show. I don't think people recognize just how treacherous this market can be. I always try to look at stocks from several different angles as detailed in how to make money in any market. For example, I like to look for areas where there's too much enthusiasm or which stocks are interrelated, not because they're in the same business, but because they have the same shareholder base. In those last few weeks that we had, during the downturn, we found out that many of the people who own these high-risk speculative stocks also own Bitcoin, typically on margin. So when Bitcoin broke down to the low 80,000s, it took a huge number of suboptimal stocks with it. Now, Bitcoin rebounded hard yesterday, and now we're seeing people return to the stocks that made up the year of magical investing, and I think it's a mistake. Why? Because while I expect a rally, I think it'll be driven this time by the stocks of companies with excellent earnings that aren't too expensive, like the ones I detailed at the top of the show. That may not happen tomorrow or the next day, but I think it's coming because many terrific stocks have been treading water, gradually building a base, and I think that can let them soar. But the super speculative stocks, these remind me of the internet stocks that didn't make it out of the dot-com era when it came to an ignominious end. I don't want to repeat that experience. Unfortunately, I seem to be fighting a losing battle. Now, there's a very good company. It's not a fly-by-night, but it's called IREN. It's formerly known as Iris Energy. It's a company building data centers for Bitcoin mining, AI startups, and most recently it got a contract from Microsoft. That's terrific. But this morning, in order to pay for these data center work that it has to do, it had to issue nearly 40 million shares at $41.12 per share, along with a gigantic $1 billion convertible bond. Now, IREN's retiring some previous debt. That's responsible. But this deal reminds me of exactly what I saw back in 2000, when things were just beginning to unravel. Huge deals to raise monies in creative ways that just kept piling on and on and on. The dot-com saw the writing on the wall and recognized it was the last chance to raise capital. I know there are some big-name people who are shorting all sorts of stocks because they think it's 2000 all over again. I don't agree with that assessment at all. In reality, it's 2000 for a relatively small cohort really speculative stocks that I talk about that no one else does. Most of the companies we deal with are incredibly well capitalized. It's not 2000 for them, Mag 7. Back then, we had more than 300 companies come public with lots of promise. We have fewer now, but the ones we do have remind me, and they won't all just come public. Some of them have been around for a while, but they all remind me of the luckless dot-coms. IREN's one of those companies. Sure, they have Microsoft as a partner to build a data center. That's terrific. And a deal worth $9.7 billion to the company over 5 years. Spectacular. But they need to keep raising money if they want to keep building, even if they got an almost $2 billion prepayment from Microsoft at the time the deal was announced. That's a lot to IREN, or any company for that matter. But if Microsoft decides it's been overbuilding down the road, it could be one and done. And these data centers are real hard to build. We've also known that the Bitcoin mining business can be treacherous, too. All I really care about, though, is you and that stock issuance. This time the deal worked. Terrific. IREN got the money it needed. But does that mean you should hold on to the stock to drop a couple of bucks on if you bought in on the secondary? Listen, the hyperscalers with deep pockets are now under tremendous pressure for their spending plans. So do you really want to be left holding the IREN bag or any other bags that are on their way if the hyperscalers stop building? Take the gain. It's terrific. You deserve it. There'll be plenty more of these deals coming. A lot of insider stock for sure. It won't be like IREN. The deals won't hold. I say you should get out ahead of in the nuclear stocks, get out ahead in the alternative energy plays and the quantum computing numbers. They have no earnings and little in the way of revenue. Believe me, if you're an executive at one of these companies and you saw how fast your stock can fall if Bitcoin gets hit, sure as shooting, you're going to bail as the stock recovers. Because now, human nature, people. Now, if you happen to own those stocks too, you need to beat the sellers to the punch. If it's anything like the year 2000, you need to skedaddle before the skedaddling gets too late to sell. I like to say there's always a bull market somewhere, and I promise to find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.